Craneware shares dropped as much as 9.6% to just over 1100 pence, after the Edinburgh healthcare software firm confirmed hackers had accessed and exfiltrated customer, employee, and partner data. The stock was already down more than 40% since the start of the year, and this is the sharpest single-day move on top of that decline. The company insists the incident is contained. The market is not behaving as though it believes that yet. The reason this particular breach carries weight is scale. Craneware's Trisis platform runs billing and revenue integrity software for roughly 2,000 U.S. hospitals and health systems and around 10,000 clinics and pharmacies. A breach of a healthcare technology supplier does not stay contained to one company's own data. It potentially touches every institution downstream of it, which is exactly the pattern seen when Change Healthcare was compromised in 2024 through a single unsecured portal, and when the Synovis attack on UK pathology services in 2022 is still causing disruption for patients in Essex and London 2 years later. But the specifics Craneware has disclosed cut against the worst-case reading. This was not a ransomware attack, production systems were not encrypted, there was no service downtime, and no service-level agreement credits triggered. External forensic specialists retained by the board say there are no residual indicators of compromise left in the company's systems. Craneware has notified the Information Commissioner's Office in the UK and the FBI in the US, which the company frames as standard disclosure given its substantial American customer base, not evidence the breach is worse than described. So, the question the market has to settle is not whether a breach happened. It happened, and Craneware has admitted it. The question is what was actually inside the files that were taken. Craneware's own statement calls a large element of the exfiltrated data non-sensitive or already public regulatory information, while acknowledging that a percentage of employee data and a subset of customer and partner records were also accessed and removed. That is where the two readings of the same disclosure split apart. The market sold Craneware down nearly 10% on the day, treating the breach as a serious reputational and operational risk for a company whose entire business model depends on hospitals trusting it with financial data. Peel Hunt, the retained broker, went the opposite direction. It repeated its buy rating and its 1,700 pence price target, calling the incident not uncommon and, in its own words, certainly not existential. What makes the broker's confidence worth examining rather than dismissing is that it is built entirely on the negative space of the disclosure. No encryption of production systems, no service downtime, no residual attacker presence, according to external specialists. Management itself described the exposed data mix as skewed away from protected health information, explicitly distancing the scenario from an Anthem-style breach, the 2015 healthcare hack that compromised close to 80 million individuals' records. If that characterization holds up under regulatory scrutiny, the 10% share price reaction looks like an overreaction to a breach headline rather than to the breach's actual content. The unresolved part is that Craneware itself says the assessment is still underway. It is continuing to determine the precise nature and scope of the data involved, identify affected parties, and prepare notifications, including any further disclosures regulators may require. Until that process concludes, the broker's not existential framing and the market's 10% and still falling framing are both provisional readings of an investigation that has not finished.
Zoom out, and the timing sharpens the pressure on both sides of this trade. Craneware entered this week already down more than 40% since the start of the year, before any breach was disclosed. That prior derating means today's holders are not deciding whether to buy a stable stock at a discount. They're deciding whether to keep holding a stock that was already being marked down hard, now carrying an unresolved data incident on top of it. For someone who already holds Craneware, the trigger to watch is not the share price itself, it is the outcome of the scope assessment the company has committed to completing. If Craneware's identification of affected parties confirms the data was mostly non-sensitive and regulatory in nature, as the company and its broker currently claim, that is the condition under which today's drop reads as a buying opportunity, rather than the start of a deeper derating. If the scope assessment instead expands to reveal materially more protected health information than initially characterized, that is the condition under which the broker's not existential call breaks, and the sell-off proves to have been the correct read. For someone watching from outside the position, there is a second, separate signal worth tracking alongside the regulatory scope. Craneware fended off a takeover approach from Bain Capital last year, and reports before this breach suggested another bid was expected. A depressed share price following a contained, non-ransomware incident is precisely the condition that makes a healthcare software asset with high gross margins and low leverage more attractive to a private equity acquirer, not less. If a fresh approach emerges while the breach is still being priced as existential, that would be the market signaling it agrees with the broker's read faster than the share price does. So the single variable that resolves this, for holder and watcher alike, is not tomorrow's share price. It is Cranware's own forthcoming disclosure on the final scope of the data involved, and whatever the Information Commissioner's Office or the FBI require as a result. That update is the discriminator between a stock that overreacted to a headline and a stock that is still being underpriced for a risk not yet fully disclosed.